This is a recording of your Chapter 5 Cost Volume Profit exercises. We normally do these exercises in class, but due to the amount of demonstrations I might have to do in class, there's a good chance that these exercises can't be completed. So we're going to have a complete video of the exercise, all the exercises for you. So we're going to start off with exercise 5-6. Then this company distributes a single product and it's a decorative plate. The selling price of the plate is $10. So every time we sell one, we earn $10. The variable cost of producing and selling the plate, so every time we produce and sell a plate, it's $6. And the company's monthly fixed expense is $7,500. So what that means is whether or not we sell or produce anything, we're still going to incur a monthly expense of $7,500. Our first assignment is to calculate the company's break-even point in unit sales. Unit sales, that's very important. So what we need to do is we need to go to our break-even point in unit sales formula. So let's go ahead and step through that formula in this practice set. Okay, first of all, we need to calculate the contribution margin to begin with. So we're going to take our $10 sales price. We're going to subtract out the variable cost that it costs to produce and sell a unit of $6. So that means we end up with a contribution margin per unit of $4. And what that means is this is the amount left over of our sales dollar left over after we paid to produce and sell the unit. Now, what that also means is that this is a contribution margin left over to, number one, cover our fixed costs, and number two, after we've covered our fixed cost, earn a profit. So we can now express that relationship in our break-even formula. So we start off with the $7,500 of fixed cost we need to cover. We divide it by that $4 contribution margin we just calculated, and that's going to basically tell us how many units we're going to have to sell in order to cover the $7,500 fixed cost. And we do the division, and we're going to have to sell 1,875 units to cover the fixed cost associated with this problem. Now we're asked, in the second part is we're asked to calculate the company's break-even point in not unit sales, but dollar sales. So what's the sales volume we're going to have to achieve? So again, this is a form of a break-even formula. It's slightly different than the one we've just seen in number one. Again, though, we start out with our sales price of $10. We subtract out our variable cost of $6. So now we have calculated our contribution margin just like we did in problem number one. Now we calculate what we call the contribution margin ratio. And the contribution margin ratio is that $4 contribution margin divided by the selling price. So what's the percent? It's basically saying what percentage is the contribution margin of the sales price. So in this case, it's going to come out to the $4 contribution margin divided by $10 sales price means we're going to have a contribution margin ratio of 40%. So that means every time we have a sales dollar, 40% of that sales dollar is going to go into contribution margin. Okay, let's go on to the next part of our formula. And now we take those $7,500 worth of fixed cost that we got from our problem definition here at the top. We divide that now, not by our contribution margin, but by our contribution margin ratio. So it's $7,500 in fixed cost divided by the 40% contribution margin ratio. That gives us the dollar level of sales we need to achieve in order to break even. In this case, it's $18,750. Okay, let's go on to the next, or not the next exercise, but the next part of the assignment. Now the assignment asks if the company's fixed expenses increase by $500, what would be the new break-even point in unit sales again and in dollar sales? So it's asking us for two separate computations. Let's start off with the unit sales first. Again, we're going to use the break-even margin per unit. So in this case, again, we're going to use contribution margin. Our sales price minus our variable cost equals our contribution margin. Now again, our contribution margin is what is available to cover our fixed cost and then basically add to net profit after we've covered our fixed cost. So in this case, again, we can express that by saying the $7,500 worth of fixed cost plus an increase in our fixed cost of $500. So in effect, our total fixed costs are going to equal $8,000 divided by the $4 contribution margin, and that results in the break-even point. Now in terms of units of sales, will now increase to 2,000 units because of that $500 increase in our fixed costs. Okay, we're going to do a similar computation, but we're going to use contribution margin ratio for our units and sales in this case. So again, we have our $10 selling price minus our variable cost equals our contribution margin. Now we have to calculate our contribution margin ratio. Our contribution margin ratio is that $4 contribution margin divided by our selling price, and that means our contribution margin ratio is 40%. Now we're going to take that 40% and divide it into our fixed cost plus additional $500 of fixed cost. And you can see that here. Our $7,500 of fixed cost plus the additional fixed cost from the problem, okay, divided by the 40% contribution margin ratio means we have total sales equal to $20,000. And that's the end of exercise 5-6. Okay, let's take a look at exercise 5-7. We have a company here who has a product they're selling for $200 a piece. The variable expense to produce and sell the units $150, and we have fixed costs of $75,000, which means no matter whether or not we sell or make the unit, we still spend $75,000 per unit. Also, it's not important right now, but the company has an effective tax rate of 20%. Let's take a look at number 1, which the requirement is to calculate, now in this case, unit sales. In other words, the sales in units needed to attain a target profit of $9,000 before taxes. So we don't have to worry about taxes in this case. We only want to earn a target profit of $9,000 before taxes. Okay, now in this case, we're going to utilize a variation of the break-even formula in unit sales, and you'll see how that works in just a minute. The first thing we want to do when we calculate unit sales is we want to calculate the contribution margin per unit. That's assumed Okay, requirement 3 of exercise 5.7. Exact same information we had from the previous slide, but we're going to have a slight variation in our requirements. First of all, it wants us to calculate the unit sales. And again, we're pretty familiar with calculating unit sales. When we want to calculate unit sales, we are going to use our contribution margin. I'll just put down CM up here, contribution margin. And we're going to use, again, a variation of the contribution margin break-even formula to calculate this target net profit. In this case, there's another little glitch here. We have a target net profit of $9,000, just like we did in requirement 1 of this exercise. But in this case, the requirement is basically we want that net profit after taxes. So in other words, after we pay our taxes, we want to have the target profit of $9,000. So this is going to require a variation in our contribution margin break-even / target profit formula. So let's take a look at what we do. We calculate our contribution margin just like we've done before. Now we're going to go ahead and we're going to now express the fact that we're going to have to cover our fixed costs plus our target profit, but our target profit has to be adjusted to a pre-tax number to ensure that after we pay our taxes, our target net profit will be then equal to $9,000. So this is a calculation right here, and it's similar to your target profit in calculation number 1. It's $75,000 fixed cost plus, though, in this case, our target profit of $9,000, and then this amount here represents the adjustment to adjust it into a number that basically, after we pay our taxes, we'll end up with the target profit of $9,000. So it's $9,000 target profit divided by 1 minus our tax rate, which is 20%. And so 1 minus 20% is going to be 1 minus 0.8. And when we do that calculation, that's going to come out to 9,000 divided by 0.8. That's going to come out to 11,250. Excuse my scribbles again, utilizing the mouths, but $11,250. So we're going to take our $75,000 plus our $11,250, and then we're going to divide it by our contribution margin, and that equals then the number of units that we have to sell in order to earn a target net profit of $9,000 after taxes would be 1,725 units. So let's go ahead and take a look now at the requirement number 4. In this case now, the calculation is based upon dollar sales. And again, when we're talking about dollar amounts, dollar volumes, we're talking about the contribution margin ratio. And those are basically the sales needed to attain a target profit of $9,000, but in this case, again, after taxes. So the first thing we're going to do is calculate our contribution margin ratio. First thing we do is calculate our contribution, and then we calculate the contribution margin ratio, which is a $50 contribution margin divided by our sales price. Now again, our formula has to take into the account that we need not only to cover our fixed costs, but in order to earn that target net profit, we're going to have to adjust that target net profit by our tax rate. So the way we're going to do that again is we take a look here. We take basically our target net profit divided by 1 minus, again, our tax rate, and so it would be 1 minus, or sorry, it would be 1 minus 0.2, which means we would be 0.8. So it would be $9,000 target profit divided by 0.8. And again, that would come out to, in this case, again, $11,250. So we have to cover not only our fixed cost, but then we have to cover our target profit before taxes of $11,250. Divide that by our 25% contribution margin ratio, and the amount at the end is going to be $345,000. Okay, now let's take a look at exercise 5.10. We have a company here that makes 2 products, video games. One's a running game and one's a skiing game. Now, in this case, we're given basically the contribution income statement. Sales minus variable expenses equals your contribution margins fixed expenses and net operating income, and we're given that for running and we're given it for skiing in terms of sales and variable cost and contribution margin. The fixed expenses, since they're fixed, can't be traced directly back in this case to either running or skiing. So let's take a look and first of all compute the overall contribution margin ratio for the company. So actually it's a fairly easy calculation. Our total contribution margin is $88,000 and our total sales are $160,000. So we take our $88,000 total contribution margin, we divide it by $160,000 in total sales. So our contribution margin ratio in this case is going to come out to 55%. Now we need to compute the overall break-even point for the company in dollar sales. Now remember, in order to do a break-even point in sales, we're going to use contribution margin ratios. So we've already calculated that for the total company. We also know how much our fixed expenses are going to be, in this case $41,250. So the calculation is going to be fairly easy. We take the $41,250 in fixed costs, I call them fixed costs instead of fixed expenses. We divide that by our 55% contribution margin ratio, and that means the overall break-even point for the company in total sales dollars is equal to $75,000. Now let's take a look at requirement number 3, and you'll notice the information here at the top is exactly the same information from the previous slide, and I've also included some information right here regarding the break-even point in sales that we calculated from step 2, which was $75,000. So now we're asked to verify the overall break-even point for the company by constructing a contribution income statement showing the appropriate level of sales for the products. So first thing we're going to do is we're going to separate our sales into our various lines. Sales for running 120, sales for skiing for 40,000, and total sales are 160,000, which is exactly the same amounts that we see up here. Okay, the next item then is we're going to basically take the percentage of sales of running versus skiing of the $160,000. So $120,000 of $160,000 is 75% of sales. In the case of $40,000 of $160,000, that's 25% of sales, and of course that's going to add up to 100% of sales. Now the question is that what are the sales at break even based upon these apportionments of sales? The first thing we have to remember is we calculated our break even point in total sales of $75,000. So in order to come up with our sales at the break even point, we take the 75% that we calculated times $75,000, and that equals $56,250. We also take the 25% of the $75,000, and that comes up to $18,750. Of course, then when we total our running and skiing sales at break even, that's going to equal the total sales that we calculated from step 2, break even, $75,000. Now we're going to calculate, we're going to show the proof here in terms of running and skiing in total in terms of a contribution income statement. And again, it's always important to remember what I like to do is when I'm developing these statements is kind of sketch out the statement so I know I'm not going to forget anything. So I have my 2 product lines and my total, plus more importantly I have my line items. I'm going to have sales minus my variable cost equals my contribution margin, minus my fixed cost equals my net income. So in this case, I'm going to start filling in the information. First thing is running sales are $56,000. My skiing sales at break even will be $18,750, which means my total overall sales would be the $75,000, which is exactly the way it needs to be. Now variable costs are just a little bit trickier. You have to remember variable costs vary directly with our volume, and in this case basically with our sales. So in this case what I see is that when I take a look at my variable cost for running, my variable costs are $55,000 and the sales that produce those variable costs are 120. So if I do division, that means my variable costs are 45.8% of my sales. Now, if variable costs are variable, that means that relationship is going to continue on at my sales levels. Same thing for skiing. $17,000 of fixed cost divided by my $40,000 of sales, meaning that my variable costs are always going to be 42.4% of my sales. So in this case, the way I calculate my variable cost are simply, I take my total sales times, I've just lost my marker here. Okay, I take my total sales of $56,250. I multiply that times 45.8%, and my variable costs then equal $25,781. I'm going to do the same thing for skiing with variable cost, $18,750 times of 42.4%, and that comes out to $7,969. If I crossfit those, it comes out to $33,750. Now I can calculate my contribution margin. And you can see I run the contribution across the page, running $30,469 contribution margin. In other words, that's the amount that's left over after basically of my sales, after I paid for the variable cost of producing and selling the unit. And the skiing line, $10,781 contribution margin, which represents the amount that's left over after I paid for the variable cost of producing and selling the skiing units. So my total contribution margin for the company is equal to $41,250. Now from that, then I'm going to subtract my total fixed cost, which happened to be the $41,250. And you'll notice when I do that, my contribution margin of $41,250 minus my fixed cost of $41,250 equals net income of 0. So at this point, I have demonstrated that that is my break-even point. Okay, exercise 5-13. Here we're given a contribution margin report. Sales minus variable expenses equals the contribution margin minus fixed expenses, or most of the time I call them fixed cost or variable cost, equals 85,000, net operating income of 115,000. Plus we're given, in effect, per unit information. Our sales price per unit is going to be $18. Oops, I didn't get my marker worked. One moment. $18 per unit, and my variable costs are going to be $10 per unit. So in this case, actually there's a couple ways I can approach this, but I'm going to use the most straightforward process possible. Here it says, what is the revised net operating income if sales increase by 20%? So all I've got to do is calculate this in a formula. I know my sales per unit, or the number of unit sales, is 25,000 units. So I start off with that. And I'm going to increase my sales by 20%. So I'm going to multiply 25,000 times 120%. Now that amount then I'm going to multiply times my sales price of $18 per unit. So the total amount in terms of my sales would now go from 450,000 up to $540,000. Okay, also you have to remember that since I've increased my sales in units, I'm also going to increase my variable expenses since the number of units are going to increase. My 25,000 units from above plus that 120% increase in units times my variable cost per unit equals $300,000. So the amount then, my variable cost will increase by $300,000. So 540 versus $300,000 gives me a contribution margin of $240,000. My fixed expenses are not going to change because they do not change. So it's going to be $85,000, leaving me with net operating income of $155,000. Okay, let's look at requirement number 2. And in this case, it's the same information as we had previously, but it says in this case, consider each case independently. What is the revised net operating income if the selling price decreases by $2 a unit? So that's one of the items, decreases by $2 a unit, and the number of units sold increased by 15%. So again, we have to look at the effect on sales. So let's take a look at that. Okay, we know we're starting out with 25,000 units again. Now we're going to assume that the number of units sold, not assume, but we're told that the number of units sold increased by 15%. So it's 25,000 units times 115%. But we're also been told that the selling price per unit decreases by $2. So that's going to be the $18 selling price we originally had, but minus $2 selling price. So in effect, it's $16 per unit. If we do the multiplication, then it comes out to $460,000. So that's the amount of our sales, total sales for the units. Again, since we're having a change in unit volume, we're going to have to account for that change in our variable expenses. So again, we're going to see the 25,000 in our units times a 15% increase in our units, but there's no change in variable cost, so that's going to remain the same. So it's going to be 25,000 times the increase in the units times our variable cost equals 287,500, and that's the amount that comes out to, 287.5. I made a mistake over here. That'll probably carry through. Let's take a look. No, it doesn't in this case. That's good. So basically our contribution margin is 172.5. Our fixed expenses aren't going to change at 85,000, and our net operating income will be 87,500. Okay, let's take a look at requirement number 3. And again, the information is exactly the same as presented in the previous slide. And you can see right here the contribution margin income statement. And again, it says consider each case independently. Now the requirement in this case, what is the revised net operating income if selling price increases by $2 a unit? I'll put that right there. Fixed expenses increased by $15,000 and the number of units sold decreased by 4%. So let's do the calculation on these items. Okay, if we take a look at our overall calculation here, we start out with our 25,000 units. Now to that then, we're going to decrease the number of units sold by 4%. So in this case, 25,000 units times 1 minus 4%, or in effect 96%, gives us our 4% decrease. So 25,000 units times 96%, which by the way would be 24,000 units, times our $18 selling price, plus we're told that our selling price increases by $2 a unit. So there's our $18 selling price plus our increase in selling price. That's going to total $480,000. So I'm going to post that to that board right there. Now again, since we have a change in volume, that's going to change our variable costs. So let's take a look at that. We take our 25,000 units we originally started out with, we subtract the 4% decrease, and our variable costs aren't changing, so it's going to be the 24,000 units times $10 a unit. So our variable costs are going to go down to $240,000. Okay, and we mark that there. Now our contribution margin, when we do the calculation, comes out to $240,000. Now our fixed expenses, we're told our fixed expenses are going to increase by $15,000. So we have to account for that. So we take the $85,000 of our fixed cost plus a $15,000 increase in our fixed cost means that our total fixed costs are now $100,000. We subtract the $100,000 for our contribution margin, and our net operating income comes out to $140,000. Okay, let's take a look at exercise 5A1. It's part of the appendix. It deals with the computation of mixed cost. The area, or the one that I'm going to go over, is demonstrating what we call the high-low method of calculating mixed cost. Now remember, one of the things that I've told you is that a mixed cost contains components of not only variable cost but also fixed cost. So sometimes it's really hard to determine which costs are variable in a mixed cost and which are fixed. Now in this case I have a problem where it says using the high-low method, basically estimate the fixed cost of electricity per month and the variable cost of electricity per occupancy day. Round off the fixed cost to the nearest whole dollar and the variable cost to the nearest whole cent. Okay, utilizing the high-low method, we use a set of data for a period of time. In this case, we're going to use occupancy days, and we're going to use electrical cost on all these items by month. So what we want to do is pick out the highest in terms of highest volume, which is occupancy days. I'll put V there, and electrical cost, which are C for costs. So we want to find the highest and the lowest items. So we take a look at these, and in scanning I look at March, and the electrical costs are $8,864 with occupancy days 3,794. That appears to be the highest that I can find on that chart. Okay, now I'm going to try to find the lowest, and I believe that's in September, where there's $1,952 worth of electrical cost, and the occupancy days in this case is 384. So I believe I found the highest and the lowest vectors here. So now it's a matter of going through a calculation process, and let's see how we do that. Okay, I take the electrical cost associated with March, $8,864, and I subtract out the electrical cost associated with the lowest month of $1,952. I'm going to divide that then by my volume. In this case, I'm picking occupancy days. 3,794 is my highest, and again, lowest would be 384 days. I call them units, but days, you could call it whatever you want as long as you realize it's a volume. So I then subtract the difference. $8,864 minus $1,952 gives me a difference of $6,912, and when I subtract 3,794 units from 384 units, I come up with 3,410 unit difference. Now it's a matter, I can now calculate based upon this ratio here, I can come up with an estimate of my variable cost per volume. And what that means is that when I do the math, it's going to come up to $2.03 per day. And that's in terms of my variable cost per day. $2.03 and that's again according to my occupancy days, my volume. Okay, now I've got the variable cost component of my volume. Now I have to come up with the fixed cost component. So the way I do that is I kind of back into it. I start off with my 3,000. I just pick either the highest month or the lowest month, or actually any month in this chart will do, but I'm going to pick the highest month. I take the 3,794 in days, the unit volume, the 3,794. I'm going to multiply it times the variable cost that I said that would be occurring per this volume here, these units. And what I'm going to do is I'm going to take that multiplied times a 2.03, and I come up to total variable cost in March of $7,702 of variable cost. So now if my costs are composed of variable cost and fixed cost, since I've now calculated my variable cost, it should be fairly easy now to squeeze out, or if you will, extract my fixed cost. So let's take a look at that calculation. Okay, my total cost, let me change color here just so we have a little bit more contrast. My total cost for the month of March is $8,864, and that corresponds to my total cost right here. $7,702 of that during March was due to the variable cost component or portion. So if I take $8,864 and subtract out the variable cost portion, that means I have $1,162 of fixed cost remaining. So my variable cost per unit is $2.03, and my fixed cost component for the month is $1,162. When I say $2.03, that's based upon unit of volume. So that's the end of exercise 5A. We have an additional exercise, and again, it's another high-low calculation. I'll leave that to your own pursuits. So have a good day. Thank you very much.